Okay, we're gonna start now. I'll be sharing my screen, so we can start. Okay, we're gonna start right away. So this is the introductory webinar into the in preparation for the volume 2 of the City Mastery course. Now, I want this webinar to last only an hour. So this is like 9:30 now. So by 10:30, we're going to stop. If we finish or we don't finish, then I'll start taking questions and answers. I don't know if I don't know if you guys are hearing me, to be honest. Can you see my screen?
Hi, Mr. Jude. We can hear you loud and clear.
Okay, great.
Hi, we can hear you.
Okay, great. Can you guys see my screen?
Yeah.
Not yet.
Can you see it now?
I can see it.
Okay,
now.
great. So I believe everybody can
Yes,
see it.
yes,
So
we can see it now.
So
Yes.
please mute your mic. Please mute your mic so we can start. Okay, great. So this is the introductory webinar to technical analysis, which is the volume 2 of the City Mastery course. And we're going to talk two things. Like I said, this webinar is going to be for 1 hour. Well, I'm going to introduce you to technical analysis, what it's all about. And then we're going to go into financial charts. And we'll talk particularly about candlesticks. Now, I don't know if you can cover the whole extent of it in an hour. If we can't, we'll stop wherever we can cover in an hour. Then we'll hold another webinar where we go through it again. That is starting from ordinary refresher, then starting from where we stopped and going through the rest. So I think we should just get started. So the outline of what we're going to learn in this webinar is, like I said, an introduction into technical analysis. Then we're going to go to tools and steps required to trade profitably using technical analysis. Then we're going to talk about financial charts and its origin. Then we're going to delve into candlestick charts. Then we'll talk briefly on bulls and bears. Then we'll talk about types of candlestick patterns, what they mean, and how to use them. So let's continue. And of course, there will be question and answer. Now, so basically, there are two ways. There are two ways you can analyze a cryptocurrency. To know if the price is going to go up or it's going to go down. You know, basically, as traders, what we want to do is to make profits. Buy a coin when it's low and sell it when it's high. So to know if a coin is going to do well, there are two basic ways we do that. We do either fundamental analysis or we do technical analysis. Now, fundamental analysis is evaluating a coin based on the price, the project, the team involved, if they have a track record or if they are people of reputation. We look at the future, we look at the roadmap of that project to see if this will really have a project that is worth something. Then we look at news and some other things to actually buy that coin. So that is basically fundamental analysis. For example, let me get an example that has to do with news. In July this year, July 2020 this year, there was a news that came that US banks are going to be allowed to start storing cryptocurrency for their customers. And when that news came out, the price of Bitcoin rose from $9,000 per Bitcoin to $12,000 as a result of that news. So that is an instance where fundamental analysis based on news can affect the price of a cryptocurrency asset or an asset generally. There are others that are not based on news. It can be based on, like I said, from what you're seeing, the team, the future growth, and the roadmap. Roadmap is actually important. If I know that, okay, these people are going to hit this target by this time, people can start buying that coin and sell when they hit the target. So that is fundamental analysis. And technical analysis, on the other hand, is the study of the price movements on a financial chart. Now, it is forecasting the future price direction by analyzing historical price movements. So what I'm saying is that in technical analysis, we go and look at what the historical price, how has this coin performed in the past? Then with all the information we have collected from this historical price, we try to forecast the future price. Now, in technical analysis, we do not predict prices. We don't say we'll predict because you can never predict the price. You can never say this is what the market is going to do. But you can forecast. You can say, okay, based on this, based on what has happened in the past, at this time and this movement, this is going to happen. I give an example by saying, we can say when A happens, if we look at historical prices and we see that anytime a kind of movement happens, there is always a particular movement that follows it. All right. So we can now forecast that, okay, when A happens, it is either B or C that usually happens. But in most cases, B happens. Then we can then make our trade decision based on this. So we're using historical price movements to forecast future price movements. Our goal is to achieve, like, okay, if we tend to be 70% accurate, that is very good. If you are 60% accurate, that is very good. All right, so that is actually technical analysis, looking at historical price and trying to forecast future prices. Let's proceed. So technical analysis is a game of probability. We are not sure for certain. You're just trying to, it's a game of probability, and we're trying to see the one that is most probable. Because if we're able to arrive at the most probable one, then we can make that trading decision. So technical analysis and fundamental analysis. So what are the difference between technical analysis and fundamental analysis? Now, core technical analysts forecast future price movements from historical data. They do not bother with fundamental analysis. They believe that fundamental analysis is already incorporated in that historical price. So there's no point for them looking at news, since news has been affecting the historical prices. Therefore, the data they collect from the historical price is enough for them. But core fundamental analysts believe that historical price has nothing to do with the future prices, and future prices can only be associated with fundamental analysis. Now, I know a group that do I won't say fundamental analysis is wrong. I won't say technical analysis is wrong or right. Now, there are people that do only technical analysis. There are those that do only fundamental analysis, and they're actually doing well. Now, I know a group that what they do is fundamental analysis. They just look for coins that have the potential of doing, say, 100% a month. I'm actually in that group. They look for coins that have the potential to do it for doing 100% a month, and they find like 2 or 3 of those coins, each month, and they invest in this coin. So most times, these coins they find actually do 100% in a month. One of those coins did this happened like 2 months ago, did 1,000% in 6 weeks. So they're only doing what? Fundamental analysis. So technical analysis works, fundamental analysis works. But the thing with fundamental analysis is that it might not always be reliable. So fundamental analysis might not always be reliable. You might not always find coins. You might not. So it is not. It is not something that I would say. It is. How do I put this? It's not something that is sustainable over a period of time. All right. But for technical analysis, yeah, it is more sustainable. It has been tested through time, and you always find trades to make using technical analysis. So for a very good trader do both technical analysis and fundamental analysis. For example, before I can start trading a particular coin, I should carry out some fundamental analysis on this coin to know if this coin is here to stay. If I trade coin that is a pump and dump coin, I may lose money. So if I know that this coin is stable, the teams are great, and the coin is going to stay for a very long time, then I can start trading on that coin using technical analysis. So again, a very good trader do both technical analysis and fundamental analysis. So from here onward, we're going to be talking more on technical analysis. So now, what are the steps you need to trade profitably using technical analysis? Now, these steps include that one, you have to understand the market structure. So when you open a chart and look at the market, you have to know who is in charge of the market. Is it the bulls? Is it the bears? Is the market trending up? Is the market trending down? Is the market consolidating? So if you understand who is in charge of the market, that's the first thing you do. So the steps to technical analysis is one, to understand who is in charge of the market. Two is the ability to interpret financial charts. Example is the candlestick pattern. Then you have to know how to make use of indicators such as the RSI, the MACD, the volume, Bollinger Band, money flow, stochastic oscillator, Fibonacci retracement, and so there are so many of them. But you don't need to learn how to use all of them. Knowledge of 2 or 3 of them is okay for you to trade profitably. There are persons that actually use only one with some other thing, like 2 at most, and they trade profitably in technical analysis. So you have to understand, the next thing you have to understand is support and resistance. You have to know what support and resistance is. You have to understand the support and resistance region. The next thing is trend and trend lines. You should be able to identify a trend when it's forming. Yes, you should be able to identify a trend when it's forming and be able to follow the trend and know when the trend is going to reverse. You should be able to know how to draw trend lines. Again, you should be able to know how to identify patterns. If you can identify patterns, you can trade profitably using technical analysis. The next thing you do, if you have understood this, is to develop your trading strategies. Now, once you master all this above, you can develop your own trading strategies. A lot of people have their own trading strategies that works well for them. If you have a good trading strategy, the next thing is to master money management and risk management. If you don't manage your money well, even if you're using a good trading strategy, you can blow your account. So it's very important, you know, okay, this is the amount I'm going to put in this trade, and this is what I'm going to risk. This is where I set my stop loss. This is where I set my take profits, and all of that. And again, you have to practice and practice and never stop learning. So this is how you This is how you master technical analysis. What we're gonna do today is, like you saw from the webinar, is candlestick patterns, and that is what we're going to get straight to right away. So to do that, the first thing we're going to look at is chart basics. We're going to look at chart basics. We want to look at type of charts. Then we'll look at history of the candlestick chart. Then we'll look at elements of the candlestick chart. Then we'll look at bulls and bears. You have to actually understand these topics are actually somehow intertwined. So if you're talking about candlestick patterns, it's good you understand support and resistance. So in the modules now, if I've talked about candlestick patterns and I start talking about support and resistance, it will help you better understand candlestick patterns. Okay? And because you've learned candlestick patterns, it will help you better understand support and resistance. So it's more like you go to this one, they are somehow intertwined. So bulls and bear as well. I felt I should just put bulls and bear so to help you understand what I want to talk about in candlestick patterns and the signals they give. And we're going to end it with Q and A. And like I said, if we are not able to meet up with, because the candlestick patterns are a lot, if we are not able to meet up with that, we might have to stop and continue on another day. Like I said, this class is going to last for an hour. If you have questions, you can always drop them. I'm not really very familiar with this Zoom, so I'm trying to still figure out things. Okay, anyway, let's continue. So let's look at chart basics. All right. Now, when we're in primary school or secondary school, I don't know how this thing is supposed to be drawn here. Okay, when we were in primary school or secondary school, we at least we were taught chart basics. We were taught simple charts. So a simple chart has a y-axis and an x-axis. The y-axis is usually frequency, while the x-axis can be team, mark, and things like that. The y-axis is on the right-hand side, and the x-axis is at the bottom. While the lines shows us a visual representation of what is going on. So this is a chart of, say, CTM gene, and people that register for CTM gene by months. So in January, I had about 40. In February, I had about 35. March, it dropped down to 20, and April went down to it went up to 45. So this is more like a visual representation of what a chart is. Now, all charts follow this basic principle, which is what you're seeing: the x-axis, frequency; the y-axis, mark, time, team, and all that. And like I said, they follow this basics with minor changes. So if you look at a financial chart, what they did was to move the y-axis from the left here to the right. All right, the x-axis is still on the bottom, and the y-axis is no longer frequency, but it is now time. Sorry, it is now price. The y-axis is now price, while the x-axis still shows time by seconds, days, weeks, months, hours, and the rest of those things. And at the top right corner here, we have what we call the ticker. That is the cryptocurrency against another cryptocurrency. So let's look at a typical chart based on TradingView. So you have on the right hand side, which is the y-axis, you have the prices. At the bottom, you have the time. And at this side, you have the ticker. So the ticker here is Bitcoin against Theta. So this is BTC. Some estimates we write as BTC against USDT. And this is a daily chart. So charts follow this, all charts follow these basics. So that said, let's move on to financial charts now. Types of financial charts. There are basically three types of financial charts. We have the line chart, which is what we looked at a while ago. We have the bar chart, and we have the candlestick charts, which is what we're going to delve into right now. So the line charts. The line charts is the most common type of financial charts. You must have seen it. You can easily recognize that and actually understand it without anybody telling you what it is. So the line chart shows the price at each point on the line relative to the period. So like I said, the bottom is a period, while the y-axis is the price. So the line chart shows us the price at each point in the graph relative to the period. It shows us if the price is trending or consolidating. So these are the simple things. It shows us as well support and resistance on the chart as well. Now the line like if the line chart is common, but the line chart, if you want to trade, is not really relevant in trading. We need a chart that is going to tell us more stories, and that is where we'll come to bar charts. The bar chart represents more information when compared to the line charts. Each of the bars, I will show you a picture of the bar chart after this. Each of the bars represents a period of time. It can be 1 minute, 1 hour, 4 hours, 1 week, a month, a year, and so on and so forth, 6 months. Now, in other words, each bar shows you the price action in a financial market in a given period of time. From each bar in a bar chart, you can see the starting price for that period. We call it the entry price. We see the lowest price for that period. We see the highest price for that period. And we see the end price or the exit price for that period. Now, let me show you. Also, the bar chart also shows you support and resistance, and shows you if it is trending, if the market is trending or consolidating. Now, this is a typical bar chart. Let's look at this one. I don't know if you can see my cursor. This one at the top, the red one at the top. Now, this thing that points out to the left. I point out to the left depicts the entry price. Come again, like I said before, each bar in this bar chart represents a period. It can be 1 minute, it can be 1 hour, it can be 15 minutes. It just represents, just know that each of these bars represents a period. So in that period, it's saying that the price started here at this first pointer and ended at this one pointing to the right. So it's telling us story, price started here and stopped here. It's also telling us that during this time, price went as high as this. It went up to this top tip and also came down to this low and exited here. So each part tells us that we started here, we went high here, we came down to this low, we came up again and exited here. So the bar chart gives us more information when compared to the line chart. So after the bar chart, we have the candlestick chart. The candlestick chart tells us more story. As a matter of fact, the candlestick chart is the most common chart in trading. It is because, like I said, it tells us more story, more story. It helps us to better visualize and better recognize price action. Just like the bar chart, each candlestick represents a period of time. 1 minute, 1 hour, 1 year, 1 week, 4 hours, and so on and so forth. The candlestick also shows us the opening price, the closing price, the lowest price, the highest price. And for the candlestick, the color of the candle is a function of the opening price. It's a function of the color just depicts that, okay, the opening price. If the color, I will explain that later in this webinar on this slide. So this is a typical candlestick pattern, and like I said, we're going to talk more on candlestick patterns. So let me go and break it down one by one. So first, we're going to look at the history of the candlestick chart. Then we'll look at elements of the candlestick pattern. Then we'll look at types of candlestick pattern, their meaning, and the signals they are telling us. And I think that is the most interesting part of this webinar. That is the candlestick pattern, their meaning, and what they're actually telling us. So let's get to it. I don't know who is drawing this thing. I don't know how it's happening, to be honest. Okay, history of the candlestick pattern. The candlestick pattern was invented in Japan in the 18th century. That is the year 17 this, 17 that, 17 that. So it was invented in the 18th century by a Japanese rice trader by the name Munehisa Homa. Now, this trader is considered to be the most successful trader in history. His discovery and use of the candlestick pattern has been estimated to have made him over $10 billion in today's dollars. Now, he was known as a godfather, as the god of the market in his days. The candlestick chart was introduced to the Western world by Steve Nielsen in his book, Japanese Candlestick Charting Techniques, in the year 1989. So this means that the Japanese has been using this candlestick pattern for over 200 years before it was actually introduced to the Western world for we here to use. So that said, that's just the history of the candlestick pattern. So it was invented in Japan. So elements of the candlestick patterns is that it should have an open price, a closed price, a high or the highest price, the lowest price, and the color. And let's look at them one by one. So let's look at this. This first part here can be open and can be closed. This first line, okay, let me talk about this first. Now, this big part of the candle is called the real body of the candle. All right, the thick part of the candle is called the real body of the candle. Now, this long thin extension, the thread, is called the shadow. Some people call it wick, some people call it tail. All right, so we can call this one the upper shadow, or the wick, or the tail, whichever one you want to call it. It's accepted. So throughout this, the rest of this presentation, I might be calling it, I might call it shadow, I might call it wick, I might call it tail. Just know that that is what it is. Then this one too also represents the lower shadow. So this is the lower shadow, lower wick, tail, whatever. So this point here is entry or exit. This point too is also entry or exit. Now, so like I said, it can be open That's why I wrote here open or close, open or close. So if here is the opening price and here is the closing price, it means that price dropped from here to here. That candle is going to be red. It's going to be a red candle. If the opening price is higher than the closing price, the candle is going to be red, and we call it a bullish candle. If the opening price, if here is the opening price, is lower than the closing price, that candle is going to be green, and we call it a bullish candle. Let me show you my example. So let's take a look at this. So for this, we have the bullish candle is green, the bearish candle is red. In some instances, they don't give it this color. They give the bullish candle white, and they give the bearish candle a black color. So like I said before, for this bullish candle, the open price is the price started here at this point. When this time, like I said, each candle represents a time. It can represent 5 minutes, it can represent 10 minutes, it can represent 1 hour. So let's say this candle is representing 1 hour. So at the beginning of the hour, the price was at this point. Then the price dropped to this point, to this low, climbed back up, got to this point, came down, and left here. All right? So the open price is lower, or the closing price is higher than the open price. So this is a bullish angle because the price climbed in that period. The same way, if the open price is higher than the closing price, the candle is red or black, as the case may be. It means that the closing price is, of course, lower than the opening price. The price dropped in that period. Candlestick and time frame. I've talked about different candlesticks. I wish this can be bigger. I don't know if you guys can see this well. Now, these are just different how do I say it? So what I'm trying to say here is, for this one here, each of these candles represents 60 minutes. For this one, each of these candles represents 30 minutes. Then for this one, each of the candles represents 15 minutes. I actually took this from the same chart. So if you check this one out, this candle is a summation of this and this candle. It's a summation of these two candles is what formed this one candle. The same way, this candle here, this first one in the 30 minutes side, is a summation of this and this candle, the first and the second candle in the 15 minutes chart. And so this 60 minutes candle is a sum of the first 4 candles in the 15 minutes chart. So this is we say candlesticks can be fractal. In other words, you can expand them or break them down into smaller time frame. But know that the bigger time frame are considered to be more are going to be stronger. The signals the bigger time frame gives are more stronger than those given by the smaller time frame. So if the bigger time frame is going bullish and the smaller time frame is going bearish, in my mind, even if I want to trade a smaller time bearish, I should not have to trade it for a short time. That all in all, the bigger time frame the market is going to move in the direction of the bigger time frame. So let's talk about bull and bears. Let's talk about bull and bear. Now, before we proceed with candlestick patterns, before I tell you the rest of the things and their meaning, we need to understand bulls and bears because we're going to be hearing it a lot, and we need to really understand what they are and what they are saying. Now, at every point in time, the financial markets have three structures with regard to who is in charge of the markets. Like I said initially, I said when you look at the fundamental chart, you should try to know who is in charge of that market. Now, so if you look at the charts, three things can be happening. The bulls can be in charge, the bears can be in charge, or neither of them can be in charge. So the question now is, who are the bulls, who are the bears, and who are the bears? So the bears or the bulls, let me start with the bulls. The bulls, we see the bulls as the buyers. Now, when there is more buying activity in the market, when a lot of people are buying a currencies, let me use Bitcoin. When a lot of people are buying Bitcoin, the price tends to increase, and we say the market is bullish. So from this picture, you can see the arrow is going up, and you can see the horn of the bull going up. So if a lot of people are buying, the price is going to keep increasing. So we say the market is bullish. All right? So when you say the bulls are taking over the market, it means that the price is increasing, and it means that the buyers are buying and buying and buying. So that is the bulls. Now, so the same way, we say the bears, we see the bears or the bears as the sellers. When there is more selling activity in the market, the price of that cryptocurrency asset tends to fall. And we say the market is what? Bearish. Now, when buying and selling activity is fairly equal, the price tends to oscillate about a small price range. When that happens, we say the market is consolidating, or we say and there's an indecision in the market. So we don't know what's really happening. So the bears are not in control, the bulls are not in control. The price is just maybe kind of stable at a particular price range. So when you look at the market, like I said again, you have to know who is in control. Is the price, is it rising? Is it falling? Or is it just maintaining a small price range? So in summary, you can see the financial chart as a fight between two parties, the bulls and the bears. Sometimes the bulls are winning. When the bulls are winning, the price is increasing. Sometimes the bears are winning. When the bears are winning, the price is dropping. And sometimes both of them are resting. The price is consolidating. They are resting, reloading to resume that fight they started. These fights are reflected in the price as price actions. So what price is doing is what we call the price action, is as a result of the fight between the bulls and the bear, and there's the buyers and the sellers. Who is more in control? And the candlestick paints us the perfect picture of what is really happening in the market. Don't worry, when we get to start looking at each candlestick pattern, you get to understand more on what I'm talking about. So for the rest of this webinar, I can be using bulls and bears interchangeably. So when I use bull or buyers, bears or sellers, I can use them interchangeably. So just know that the bulls are the buyers, the bears are the sellers. When I talk about the bulls, I'm talking about the price. Their buying activity is going on and the price is going up. When I talk about the bears, I'm talking about the sellers, that selling activity is going on and the price is likely to fall. So if you understand this, let's now look at candlestick body size. Now I don't know, should I pause to take questions or should I continue? I actually need feedback right now. I'm still trying to figure out to work Zoom. I've been talking for a while. I don't know if you actually am hearing me.
Hi, Mr. Jude.
Yeah.
Yeah, we've been hearing you.
Hi, everyone.
Nice job. We got a bit of most of the explanations you've provided on talking about candlesticks, the bull and the bears, especially introduction to technical analysis. So I guess everything is fine as of this point.
All right.
Thank you.
All right. Let me continue then. Thank you very much for the feedback. So let's look at candlestick body size. Okay. So like there are three bodies. So you have the red body, the green body, and a small body. So this body is big. It's bigger than these two bodies are bigger than this body. So when you have a big, we're looking at the market psychology now. So when you have a big red or green body, we can say there are more buying or selling pressure. So for the red body, we say there's a lot of selling pressure. For this green big body, we say there's a lot of what? Buying pressure. Then for this small body, either green or red, we say there's not really a lot of buying activity going on in the market. So let me clear that out. The next one I want to talk about is, why isn't this thing moving? Okay, the next one I want to talk about is the candlestick shadow or tail. Like I explained before, here is the tail. We can call it either wick or shadow as well. Then you have the body. Some people call here maybe short, lower, like this is the upper tail, upper shadow or tail or wick. Then here, because it's small, some persons call it nose. Here too, nose, body, and tail. Now, it's not important that you actually know the name of all these things. The most important thing is that you understand the market psychology. So let's look at this candlestick pattern now, this first one. What is this telling us? All right. Now it's telling us that since it's a black, like I said, the black body is also the red candle, while the white body is also the green candle. So let's look at the story this first candle is telling us. It's telling us that since the black body, it means that the price fell. It means that, where's my cursor? It means that the price started at this point. The opening price started here. All right. It moved up as well.
Mr. Jude, network has been so bad here. You can't even hear you.
Can any other person hear me?
Yes, please continue. We can hear you.
Hi, Mr. Jude. We can hear you.
So if you can't hear me, don't worry. It's being recorded. So you get the recorded version.
Okay.
Okay.
No problem. We can hear you. Thank you very much. You're doing a good job. Thank you.
So let's look at this. Let's look at the story this first candle is telling us. The black body. Now you have this point. We see that the price entered here at this point and left at this point. So here, what happened is that the price entered here and went up. It means that the bulls took control of this market. They drove the price up. I don't know why my cursor kept on disappearing. The bulls are in control of this market. They took the price up and they went as high as this point. Now, for some reasons, the bears came back. The bears came back and drove this price back down. All right. So in this for this candle is telling us that the bears are in control of this market. Okay, for this candle too, the price it's a bearish, it's a bullish candle. It means that we entered here and exited here. So for this candle, when the price started at this point, the bears came in. When I say the bears, like I said, those are the sellers. The bears came in and drove the price down to this point. Now, for some reasons, the bulls felt like, man, we're gonna win this fight, and the bulls came back and drove the price back up, and the price left at this point. So in this case, for this candlestick pattern, we say that the bulls are in charge of this market. So these are the stories that the candlestick pattern is telling us. So that said, I think we're going to look at now the type of candlestick pattern and what they tell us about the market. So candlestick pattern, there are lots of them, but I'm going to talk on the most important ones. So one is the engulfing bar candlestick pattern. There are two types, the bullish engulfing and the bearish engulfing. Two is a doji candlestick pattern, and the same two is the doji candlestick pattern. The next one is the dragonfly candlestick pattern, and we have the greystone doji. So these three are all doji. Some people call this one neutral doji. This one is dragonfly doji. This one is, okay, this is wrong. This is not gravestone. This is gravestone. It's a typo. So this is gravestone doji. And number 5 is the pin bar. The pin bar is just the candle I explained to you. It's my, as a matter of fact, it's my, I so much love that candlestick pattern when I see it. So we have the pin bar. We have the bullish pin bar, which we call hammer, and we have the bearish pin bar, which we call the shooting star. Then we have the harami pattern, which we call inside bar. We also have the bullish harami, and we have the bearish harami. Then we have the tweezer top and bottom. We have the bullish tweezer and we have the bearish tweezer. Then we have the morning star and the evening star. So these are the candlestick patterns I'm going to talk about during the course of this webinar. I hope I'll be able to cover some of them before we end here. So let's look at first the engulfing candlestick pattern. Like I said, we have the bullish engulfing and the bearish engulfing candlestick pattern. Now, the engulfing candlestick pattern is formed when one candle fully engulfed the candle before it. So the candle at the right fully engulfs the candle at the left. There are two steps, like I said. You have the bullish engulfing and the bearish engulfing. For the bullish engulfing, you see this candle covers this candle. The candle at the right covers the candle before it, the candle at the left. When this happens, we say it is bullish engulfing. Let me repeat. Both of them, for bullish and bearish, the candle at the right is engulfing the candle at the left. Now, when the candle at the right is green, we say it is bullish engulfing. When the candle at the right, that is the big candle engulfing the other one, is red, we say it is bearish engulfing. Now, the engulfing candlestick pattern indicates a trend reversal. So when we see this, it's saying that the trend is about to change. Let me repeat. So when you see the let me start with the bullish engulfing. Let me start with the bullish engulfing. Let me go to the next slide. You guys explain it better here. So in this slide, you are seeing what you're seeing is a bullish engulfing candlestick pattern, because this is a live. I got this thing live from TradingView. You see that this candle is fully engulfing this candle. So when this happens, it means that the bulls are taking over the market. All right. So when you see the bullish engulfing candlestick pattern, it means that the market is changing direction to the upwards. So if you look at this, if you look at this now, the trend was coming down this way, and this candlestick pattern occurred here, and this trend start moving to the upward side. The trend changed. So the story this candlestick pattern tells us, and the signal it gives us, is that, man, we are changing, or the bulls are taking over, and we're driving this market up. But it is not, like I said in the beginning, it is forecasting. It is the game of probability. When this happens, this is what likely happened. It doesn't mean that this is what must happen. This is what likely happened. Okay, so when we see this, we say, okay, 50%, we are 50% sure that, okay, this may go up. So, but where it occurs also tells us more stories. If it occurs at the bottom of a downtrend, okay, we can say, okay, we are like only 55 or 60% sure that it's going to go up, because it occurs at the bottom of a downtrend. Now, the downtrend, if it occurs at the bottom of a downtrend or a key support area or region. Maybe we're going to hold another webinar where I'll talk about support and resistance. It's like if you want to trade profitably, it's something you have to master: support and resistance level. So if this candlestick pattern occurs at the bottom of the downtrend or a key support areas, then we have more probability that the market is going to change. But we still don't take this trade. We have to find confluence. Finding confluence is using other indicators, like two more indicators, to find out if they are telling us the same thing. All right, like the moving average or trend line or some other indicators. If they also tell us that, okay, this market is going to go up, then we can take this trade. Again, if a candlestick gives us a signal, we don't just take it. We have to find out where it occurs. So in other words, if you look at this, this is coming down. The bears were in charge of the market. They drove this market down. So at this point, the bears have become exhausted, and the bulls are taking over. But we don't just take this trade. We have confirmed that it's occurring at either the support at the support or the bottom of the downtrend. All right, and we use other indicators to confirm the trade before we take it. So that is the bullish engulfing candlestick pattern. So for the bearish engulfing candlestick pattern, the bearish engulfing stick pattern is a red candle engulfing a green candle. So you can see it here, see it here, see it here, even see it here in this chart now. The same thing, when you see a bearish engulfing candlestick pattern, it's also telling us that the trend is about to change to the downward, or to the trend is about to reverse. So it is going up here, and we saw it here. We even saw it like 3 times. I even saw it a 4th time. It means that the market went down. The market just crashed, just went down. Again, you don't just take a trade because you saw it. You have to be sure that you are seeing it at a key resistance area, right? It's occurring at the resistance area, or it's occurring at the top of the uptrend. If that occurs, we can say, okay, we are 65% sure that it's going to happen. Then we'll now find points of confluence. We'll find confluence by using other indicators to confirm this signal before we take it. So that is the bullish and the bearish engulfing candlestick pattern and the story that they tell us. The next one is the doji or doji. Doji is a very simple candlestick pattern. It depicts indecision in the market. The doji happens when the opening price and the closing price are the same or almost the same. So if you look at this candlestick pattern, it means that the price opened here, went down, came up, and still closed at about that same price. When this happens, we say, man, we don't know, we're not decided. We don't know who is, we can't say who is taking control of the market. And okay, what story does it tell us now? From charts, we notice that if the doji occurs at the bottom of a downtrend, all right, it signals that the market is about to reverse. It actually signals that the market is about to reverse. And the same way, we have to actually find points of, we have to actually find confluence to be sure that this is going to happen. The same way, if the doji occur at the top of an uptrend or a key resistant area, then we can see the market is about to reverse. So we can see like two doji here, and before you know it, the market starts changing direction. This is the top of the uptrend and it's starts changing direction. Again, we don't just take this trade, we would try to use other indicators to find confluence. The next one I want to talk about is the dragonfly. The dragonfly, yeah, it looks like a dragonfly. It's a dragonfly doji because it's the same thing. The opening price and the closing price are the same thing, but this one has a longer tail. It has a longer tail and a small or a short shadow, or like some persons call it, a small nose. Now, the doji shows that there is a strong, the dragonfly shows that there's a strong buying pressure. Now, the story this tells us is that the sellers drove the price down at the beginning, and for some reasons, the buyers came back and drove the price up to close the price at almost the price the market opened at. Now, when the dragonfly occurs at the bottom of a downtrend, it is, or in a key support area, it is a strong indication that the market is about to reverse to the bullish direction. Hence, it is being called the bullish doji. Now, this is also called the bullish doji. This dragonfly is called the bullish doji. So let me just use my mouse to tell what I mean. So we open here, the price came down, the bulls were, the bears were in control, and the bulls took it back up and drove the price up, and we exited here. So this, we call this a bullish doji or dragonfly. If it occurs at the bottom of a downtrend, it's a strong indication that there is a reversal. Now, someone is raising hand up. I don't know. Do you guys have a question?
Hello.
Yeah.
Mr. Jude, I'm very grateful for the nuggets you are dishing out here. It's really top notch. I've never really heard of all these concepts before, and this is good. But I want to ask, these financial chart concepts, are they applicable to both Forex and the crypto charts, or just only crypto charts? Are these financial charts concepts in general, or it's only applicable to only just one?
The financial charts concept is applicable to all markets. Forex, crypto, anything tradable that you can chart is applicable.
Okay, thank you.
All right. So let's look at example of a dragonfly. So we had a dragonfly here in this chart, and when it appeared, what happened? The price went up. So if it occurs at the bottom of a downtrend, it is a strong indication that the price is going to go up. All right, but we don't take this trade still. We still have to find confidence. We still have to confirm with other indicators to make sure that this is what is really telling us. The next one is the Greystone Doji. The Greystone Doji, right? A Greystone Doji is the opposite of the dragonfly. It has a longer upper shadow, a small bottom nose, and the opening and the closing price are about the same. So we also call it the bearish doji. We call the other one bullish doji because it leads to an uptrend if it occurs at the bottom. We call this one a bearish doji because it leads to a downtrend if it occurs at the top. So looking at it, this is an example. So I picked this up from a chart on trading as well. So if you look at this, a doji occurs here. The trend is going up. The doji occurs here, and the market starts changing direction because it occurred at the uptrend. And like I said again, this is not always the case. We have to actually confirm this signal by finding confluence with other key indicators. So that said, next thing we're going to talk about is a pin bar. The pin bar is actually my favorite. I like to trade pin bar a lot. You can trade, I trade pin bar even in binary options and all, and that's where you can trade both uptrend and downtrend. Now the pin bar, you have a long wick, a small body, and like a nose, like I said before. So that said, like I said, this class is going to last 1 hour, and this is 1 hour. What will happen is that next week we are going to finish this fundamental charts. We still have a lot of charts to show you, like I mentioned above. We still have the pin bar, we still have the Harami, tweezer, and what is the other one? The morning star and the evening star. But we're going to stop here for today because it's an hour, and I don't like my webinars lasting more than an hour. So we'll take the next 15 minutes at most to answer questions, and we'll call it a day or a night. So it's time for question and answers. So if you have questions, please go ahead and ask.
Hello. Good evening.
Okay, please go ahead. Maybe I'll learn more. I'll learn how to control this thing better because it's still not
Hello,
trying to
good
figure it out.
evening.
Yeah, good. Please go ahead and ask your questions. I'm trying to see where the chat is so that I can actually see what people are also typing because I can't see what people are typing.
My name is Stephen King.
Hello,
Okay.
click on the 3 dots. Click on more. The 3 dots labeled more. Then you'll see charts there.
Hello, can you hear me?
I can hear you,
Good
but I can't see charts. Seriously.
Okay, let me ask my question. It's on the pin bar. Thank you so much for the lecture. It's an amazing. I pray more grace to your elbow. Yeah, it's on the pin bar chart. When you started, you made mention of another name for the pin bar chart. That's what I want to just clarify. That is the hammer, and the other one is the hanging man. So I just want to know which one is the. So that's my question.
Okay, you want to know which is the hammer and which is the hanging bar, or hanging man, right? Now, when the pin bar,
Yes.
when I called pin bar, I said there are two types. We have the hammer and the shooting star,
Yes.
right? Now, even in this lecture now, I not even include the hanging man because I see them as almost the same thing.
Okay.
Right? The hanging man has more. It also has a long tail, but the body is bigger, kind of. All right. But me, I kind of classify them as almost the same thing. That is the difference between the hammer and the hanging man. It looks like the hammer, but it has a bigger real body.
Okay.
Yeah.
Okay. Thanks. God bless you, sir.
All right,
Sorry, sir, please, I have a question. Hello, can you hear me?
I can hear you well.
Go ahead.
Okay. Please, mine is just about the timing of the class. I work at night, especially on Fridays. So I don't know if it's possible for us to be having the classes on Saturday, if it's possible, or Sunday, whichever one.
The reason why I actually chose 9 is because most persons are actually at home by 9. It's unfortunate that you're not at home, but most persons are actually at home by 9. But on Saturday for me personally, I can't be starting about Saturday.
Okay.
I can't be starting about Saturday. I can't be starting about Sunday.
But you can assure us that we'll get the recorded videos, right?
Yes, you get the recorded video.
Okay.
You get the recorded video. But this request is especially for those that have subscribed to the City Mastery course.
Okay. How much is the subscription?
For the City Mastery course, like this is the volume. This is more like a tip of the
volume 2.
Of the volume 2, yeah. Okay, volume 1 is 20K, but you can still get in. If you get in now at the price of the volume 1, you will still have access to the volume 2 at the same price. Now, when the volume 2 is launched, that is when the price is going to increase.
Okay, so what you are having now is volume 1.
Yeah, the volume 1 is already there. You can go through it. Then this is just a snippet of the volume 2.
Okay.
Hello, sir. Can you please reply the messages in the chat group?
Chat box.
Chat box, rather.
Okay.
Thanks.
I don't even know where to start replying. Should I go back to?
No, just skip the other ones. The last one.
Or maybe I can help you by reading out the.
Okay, please.
The question.
Yes. Yeah, please.
Okay, the last question there says, how correct is the fundamental analysis of that paid group, sir? On a scale of 1 to 100, what is your rating?
On a scale of 1 to 100, I would say 80.
80%.
Yeah.
Okay.
On a scale of 1 to 100, I would say 80. Yeah.
Okay, somebody has now
the next webinar, it will be fixed for next week. I will also give in the Telegram group. I'm going to give time. I'm going to state. So it's going to be say from Monday to Friday. Okay, let's say from Wednesday, Thursday, Friday, between these 3 days. We can also put a pool out. Then we all choose. Okay, we can also put a pool out. Then for you guys to actually choose yourself which day is best.
Okay, I think that makes sense.
So any more questions? Do we have more questions?
Yes, I would like to find out the windows for the participants of the City Mastery Volume 1, the window for them to pay for this volume 2 is still open, right? And it's 15,000, I believe.
It's not 15, it's 20.
It's 20.
Yeah, and it's still open. Yeah.
It's still open.
Yes.
So when will the window close for them?
The window will close once the volume 2 is launched.
So when will volume 2 be
Volume
launched?
2 is going to be launched within, because there's still some finishing touches that I need to make. So I'm going to hold a webinar to complete this particular candlestick next week. And I want to hold one more webinar on support and resistance the other week. So once that is done, we launch.
Okay.
Hello,
That's
sir.
like about 2 weeks from now.
All right. Understood.
Hello,
you.
sir.
Yes.
I thought my initial thought was that you said the volume 2 will be free for those that paid for the
Yes, volume
1.
2 is going to be free for those that have paid, that already paid for volume 1, and it will still be free for those who are going to subscribe before the volume 2 is launched.
Yeah, thank you. Just wanted to clarify that.
Yeah.
Sorry, please. The account details. How do we go about paying for volume 1, please?
When you just go to ctmastery.com, you go down. There is an enroll button. If you click the button, you can pay with your card. Then if you find it difficult, you can chat me up and you pay directly. It depends on you.
Okay, sir. Okay.
Okay, Mr. Jude, thank you very much. This is Christian speaking, right?
Okay, thank you so much. I'm seeing some private chat. I don't know how you work this private chat.
Huh? Hello?
Go ahead, please. Go ahead.
Okay. This is Chris.
Okay.
I can remember that I gave you a private chat the other time. Though we selected to talk about it on Monday. I hope you can still understand.
Okay. Yes. I remember that. I actually did some work on that, so I'll get back to you on Monday.
Yeah, because the truth of the matter is that I'm highly interested in it. If the thing is actually, approved finally, I think it will make me to go deeper into this cryptocurrency of a thing.
Okay, all right. We'll talk on Monday.
All right. Thanks.
So do we have more questions? If there are no more questions, we just have to end this.
But no, well, I think we have to end it because you have actually tried. I don't think that so many of us are still awake. A good number must have gone to bed.
All right. Okay, see you guys.
No, we're still awake here. I'm just following all the questions everybody are asking. And,
okay.
Yeah,
okay.
He has actually done a very good job. I'm just hoping that I will be able to muster the required financial muscle to participate. It's all right. Thank you for your good work.
So,
right,
Mr. Jude,
yeah.
Mr. Jude, please, how soon are we going to get the recorded video version?
Say by tomorrow. Tomorrow, so it should by tomorrow. When you stop recording, it takes time for it to so tomorrow you get it tomorrow.
Okay, all right, no problem. Thank you very much.
All right, so we end it here. I think we were spent over 15 minutes trying to answer questions. So see you guys next week. You can also ask questions on Telegram and contact me privately if you need to.
Okay, see you soon.